Hey guys, Taylor with GammaEdge here, and today I want to talk to you about how to find asymmetric trades with the GammaEdge tools. And by asymmetric, I mean high reward to high risk trades. So, risking one to make 10, risking one to make five, that kind of stuff, right? And the reason that we're talking about this is because in our community, someone asked, how can I use GammaEdge tools to enable high risk reward trades like 1 to 5, 1 to 10? How can I catch those volatility spikes that inflate 0DT options? And so while the question may have been focused on 0DT, we can apply the same methodology to swing trading, right? Because the things that we do here are fractal in nature, meaning what works on one time frame works on another time frame, and what works on one ticker works on another ticker, assuming that those tickers are ample in options liquidity to where the options market can't drive the underlying spot price. And so getting into it, a problem that some SPX traders face trading 0DT is they are just kind of gambling, meaning they're just hopping in up calls or puts, hoping that the momentum continues. Sometimes it works, sometimes it doesn't, right? And in GammaEdge, hope is not a risk management strategy. So the reason that we have our web app dashboard, have our tools, is to understand the exact structural conditions that create the explosive moves that we're looking for to capture those high asymmetric trades. Right. Another way to say it is we're finding the acceleration pedals in the structure, around our transition zones that help kind of amplify these small price moves into large option gains. Because right on a day-to-day basis in 0DT market, if you're trading 0DT options, you don't need a huge move to make a lot of money. But if you don't know what you're doing, you don't have good risk management in place, you don't have good levels to interact against, good if-then statements developed, then you can lose that money very quickly and get quickly frustrated. And so the way that we go about this at GammaEdge is we use the options market structure to understand where those key inflection points in the market are. Now, if you're using technical analysis, great. If you're using some other form of market analysis, great. Not saying any one of those ways is wrong. All we are saying is that as we demonstrated through our prior newsletter articles, YouTube videos, is the options market plays a significant role in the day-to-day movement of spot price. The reason for this is just the size of the options market and its growth, and then the size of the 0DT market specifically, right? That can make up anywhere from 50 to 70% of total SPX volume on any given day. And so that's exactly what we're going to talk about here is how to identify those setups using the GammaEdge tools, complete with real numbers, specific strikes, and actionable strategies you can implement tomorrow. And so the first thing we want to talk about is the importance of net open interest, which really predicates most of the data that we are using at GammaEdge. And yes, I know some people, what you're thinking is net open interest, you automatically assume that that's naive GEX or whatever the term is. And that's fine. If you want to shoo this, go ahead. However, I will tell you that we do not make the default assumptions that a lot of people think are made. One being that the market is short calls and long puts, because we've demonstrated time and time again that the market is driven by out of money call and put activity. And we also have a robust set of intraday tools that help us understand what the intraday flow in the SPX 0DT complex is. And so, right, the pre-market structure is the structure, and that has to be navigated. And those levels that we come up with generally hold true throughout the session. And then we add on top of that what the intraday, volume activity is via our centroids to better understand, if we're having a trending day, trend higher day, trend lower day, all that good stuff. And so getting back to net open interest, something to talk about is what a lot of people don't realize is the standard open interest data, you see your broker's options change is incomplete. It only tells you half the story. And right, if you're just looking at a chain on your options on your broker, you could see 5,000 open interest calls, 3,000 open interest puts sitting at the 5,000 strike, and most analysis stops there. And traditional thinking says high call open interest creates resistance, high put open interest creates support. But this ignores something critical, which is what we just referred to in this article as the offsetting effects. We in our web app display net open interest. We have call open interest, put open interest, but we also have net open interest, right? And so what this does is this shows you what the actual synthetic positioning at each strike is. So, simply put, net call open interest is when raw call open interest is greater than the put open interest. And then net put open interest is just vice versa. There's more puts than calls at that specific strike. And so right quickly, looking at the dashboard, we can clearly see where the call dominated and put dominated strikes are. And to keep in mind, we do factor in known short positioning in our open interest calculations. So as an example, the JPM hedge that everyone knows about, we do factor that in. And we have external data providers that give us other known short positioning. And so specifically focusing on upside trades, right? Because this logic can be applied to downside trades, but we just have to focus on one side. This offsetting effect allows us to understand where the max convexity strikes are located, which are those strikes that have the highest positive net open interest. The reason that they are the max convexity strikes is because that is where the most gamma is packed, which is the acceleration factor that is the fuel to those big moves. The reason that's important is because generally, the way to think about it is, so looking at our dashboard, it's a good visualization. So the highest convexity strike, what we call plus gex, highest call gamma, also in the 0-DT complex. In this example, it is strike with the most call open interest is at 6,500. So the way to think about that is that is the largest level with the most short-term positioning. And so from spot price, whenever those traders put it on, it was out of the money. So they're taking on a ton of out of the money risk. In this example, spot price was 64.50. So they're taking on 50 points of out of the money risk. As spot price approaches that and they get to 6,500, those traders have captured all that out of the money risk. And especially being a 0-DT view in this point of view, they're going to want to lock in those gains because those contracts have rapidly appreciated in value, and they're also at max convexity when they're at the money. So from that point forward, they're going to move more linearly with spot price. And so hence why this is a key level where monetization likely is to occur, because they've captured all those out of the money risks and it's not going to appreciate as much as it had previously. And the setup is simple, right? So what we look for is, every day when we're going through our pre-market prep, we look at our transition zones, which serve as your trigger level. Reason for that is because when we are within the transition zone, this is a low pressure zone where dealers face minimal exposure. So dealers are not kind of adding to that incremental price increase, which does happen once price breaks through that level. And this is where dealer hedging kicks in and further price appreciation is expected. And then again, 6,500 in this example, this is where the max convexity is, We've just talked about all that, where we expect to see call monetization, kind of that key upside level. And so in this example, the top of our transition zone was 64.80. The transition was 6,500. Yes, that's only 20 points, but 20-point risk, but you understand where to get in and where to get out. So it's a very asymmetric trade just in terms of points, in terms of, you could be risking a couple points to make 20 points. And especially when you add in the leverage of options, those 20 points can be significant gains. And so speaking of options contracts, there's three specific ways that we can play that. One way is just an out of the money call. So, just taking an out of the money, just taking the 6,500 call, which is plus GEX, which is significantly out of the money. That's max speculation there. So here's just a P&L diagram of that. As an example, could cost $120 per contract, And the strike is going to be very low delta. And then as price continues to move up, that gamma is going to accelerate, that delta is going to accelerate. However, the risk of this trade, is it's time sensitive. If you don't get that move very quickly, that option is going to decay very quickly as well. The next is a bull call spread. So what you could do there is you could be a long a call at 64.80 and you could be short a call at 65.10. In this example, it could cost you, $400 as opposed to down here, just taking a naked call, which could cost you $1,700. And the reason that you would do this bull call as an example is because you would benefit from the price appreciation from 64.80 to 6,500, and then ideally we see that monetization at 6,500 to where that short call above 60 at 65.10 would then decay away as well, And the max gain on this trade is the spread is 30, so 3,000 minus what you paid, 400, so 2,600 is the max you can make on this. And you're again risking very little because a break below P trend, your thesis is wrong and you can get out of the trade. And when it comes to these spreads, you can tinker with them too. You can take, well, really your short call is going to stay out of money, but your long call, you can have it be at plus GEX, you can have it be at P trend, you can have it in the money, you can have it slightly out of money. It's up to you to understand kind of what you want the risk profile of that trade to look like and how much you want to pay for it. And lastly, we're just simply going in at the money call, right? This is going to act more like stock than any of the other ones that we talked about. You're kind of already past the 50 delta mark, so that convexity of the trade is not going to be as quick as when you're out of the money, and it's going to be quite expensive. So paying $1,700, right? You need a 17-point move just to break even on the trade. Something to keep in mind, any option strategy you do when you're long options is, especially for trading 0DT, is speed and time of day. Even if you're swing trading, right? You're trading, whatever, 1 week out, 1 month out, and you're out of the money, you still need that move to happen, right? And just 0DT, the closer that you enter at market open, the more time value you're capturing in the option, because right, the option is made up of two components, the time value and then the intrinsic value. Which, right, that's why we say in the bull call spread example, if you have a long in the money strike, that's not necessarily hurting you because there is intrinsic value that is not decaying away. Right, and then there is an important risk management note that I hit on earlier, which we're basically saying that these risk to reward ratios assume that you're holding to expiration and you lose the full premium paid. However, using the GammaEdge tools and those specifically the levels give you a clear exit signal. In our example that we've been using, if price breaks below P trends at 480, then the structural thesis is invalidated and you can exit for a partial loss rather than writing it to zero, which make these trades even more asymmetric to the upside than what we quoted in these examples above. And going through another kind of tangible real life example of how you put this into place. So this is the 0DT dashboard from August 28th, 2025. What we discussed in the morning, right, was the transition zone, very clear, from 6470 to 6465. That's the DEX and the GEX transition zone. Then our drunken sailor range extended up to 6480. So when you play that, if you're a bull, you want any kind of pullback to hold the DEX transition zone. We want to move up above 6480 and then right 6500. That's our key plus GEX strike on the day, the most convex GEX. So any moves we expect to kind of peter out 6500. That's kind of the ultimate upside target there. And then what happened, right? Sell off right into that DEX GEX transition zone which held. And so from this point going forward, obviously, right, like you don't want to see a dump, but we held right where we should have. And so, if you're placing a trade within this zone, but the target ultimately is 6,500, that's amazing risk to reward. Because even just like on a futures basis, you're risking 5 points to make 30 points, which is really good risk to reward, right? And then if you slap, I'm not saying that you should be doing options on this trade if you don't want to. You shouldn't feel pressured, but if you did, as an example, a 6,500 call, that's like massive gains there, or any kind. And then right price, kind of finished right at 6,500. So if you did that, call spread of selling the 6,510, and yes, I realize that this is hindsight, but watching game film, the best athletes, best teams do that. So we should do that as traders. So this is just a great example of how to use our levels, right? Or even above 6480, when we got that break in that retest of 6480, which is the top of our drunken sailor range, that is another opportunity to get in as well. And again, 6480 up to 6500, risking a couple points to make 20 points. So you guys understand, you should see now how using the level to level system, which you may have not seen before if you're not following the options markets. And then you can apply TA around this, right? Breaking a retest into that, finding some consolidation, bam, do that. Or whatever it is that you're doing. We're simply just introducing another way, another tool for your toolkit. And then so, right, just to in the article, how you're going to do this pre-market prep every day. So in the GammaEdge community itself, we have a robust SPX game plan that we write up every day, including the full complex, including 0DTE, and then include just all those key levels that we are looking at. So if you're unfamiliar how to do this, we kind of hold your hand and help you with that. But anyway, starts with opening up the web app, starts with looking at the structure for the day, identifying where those key transition zones are at, which I just talked about. And then from there, it's simply just executing, waiting for price to break above the transition zone, or if you have some other way that you're getting in using your technical analysis around those key levels that we help you identify. And then it's really just confirming that with intraday volume analysis, looking at our market trend model, which is how we gauge intraday, buying and selling. Then also look at our vol M charts, which is just understanding the momentum, which within 0DT speculation itself, both on the call side and the put side. So like in this example, the trend for the day was clearly higher. So in our example, we broke above, we held the transition zone, broke above drunken sailor range. We're seeing constructive movement to the upside, 6,500 ultimate target, which is where we got. So that's kind of how you use the tools and get those high risk to reward trades. Right, and then from there, and once you identify those key levels, it's really just understanding how you want to go about attacking that trade, whether you're doing out of money calls, at the money calls, some kind of spread, or you're even doing futures. It really it doesn't matter at the end of the day if you're using this level to level approach. Like, yes, obviously the amount of gains that you get if you're right will be very dependent on the structure. But all I'm saying is, first, you just need a solid asymmetric trade in terms of, your kind of entry, your profit target, your stop level, and then your trade on top of that. The way you express it through the instrument will then kind of enhance those kind of baseline gains. And so, right, that's really what we got for you guys today. Just key reminders: risk management is always number one, especially when you're trading 0DT. If you don't get that move quickly, you get a move against you that you need to respect your stop loss, because those contracts can go to zero very quickly. And really, just don't force it. If the trade's not there, the market's always open tomorrow, so you can come back. Last thing, since we are the sponsor of this video, right? That was a joke. If you go to GammaEdge.us, if you go to free courses, so things in this lesson, right? I know we're talking about different concepts in this lesson because, like I said, we've done 20 plus blog articles this year in 2025. So didn't spend the time to lay the foundation of some of those concepts, because you can just go here, GammaEdge FastPass, sign up for it. We'll walk you through all of our tools, methodologies, systems, strategies, all that good stuff for free. So if you're new to options, wanting to learn more about how or unlock how this can be beneficial for your trading toolkit, exactly what this is for. It's what our paid members get. This is essentially the onboarding, so no better place to start than this. And with that, I am done, so I appreciate the time, and we'll see you in the next one. Thank you. Bye.